So what's the deal with table funding in California? I've heard from people that an investor or a company can't table fund a loan in the state of California, but they can do it in other states.
Right.
What's the deal with that?
Well, so table funding is used in a lot of different contexts. I think it's important we define what table funding is in the state of California as understood by the regulators, right? The word is an industry word, and so it's not a term of art. The key understanding at the state level is California, both the DRE and DBO, view table funding as follows. It's the broker arranges the transaction. The investor funds it, but not in his name. Essentially shadow funding into escrow. The broker will become the lender of record, will close the loan, and then transfer it to the investor after close. That is what the California regulators understand table funding to be. In that context, in California, it is prohibited because under both lending regulatory bodies, the DRE and the DBO, it triggers licensing. So the DBO governs the CFL license, right? So if you're CFL licensed, you are only allowed to lend off your balance sheet. You are not allowed to lend money that is not your money.
That's typically a mortgage fund.
Exactly. Mortgage funds are oftentimes CFL licensed lenders. And in some instances, some of our clients that don't have funds are CFL licensed lenders. In those situations, it's pretty clear. The rules are very straightforward. You have to lend off your balance sheet, which means it has to be equity or borrowed funds. And so the DBO is very clear. Table funding is prohibited. Under the DRE, it gets triggered because a broker is someone who arranges 8 or more loans for the public. That transaction, whether they're shadow funding and getting assigned to or they're doing it at closing, is still viewed as the broker is arranging a loan for the public, and therefore the person doing that needs to be licensed in the state of California. Further, the state does not like it when the closing is done when it's unknown whose capital it is, because the DRE also imposes significant disclosure requirements to the end lender, who's the investor in this transaction, and there are also duties owed. A DRE licensed broker owes fiduciary duties both to the borrower and also to the investor on the note. And for those reasons, the state is not comfortable when a party is funding the note without his name being on the note and deed of trust at closing. They want it to be at closing. Now, to be frank, if you have a DRE license, that transaction is probably the bread and butter for most of our attendees here at CMA. Once you've done that, table funding is unnecessary, right? And so you can still achieve the same result using a DRE license.
And so how does it work? Does the lender or the broker in the transaction just have to disclose who the actual investor is?
Right, and it's required by law. The disclosure forms it identifies not only the risks of the transaction, but identify who the lender of record is going to be, and the intended lender of record, right? And in California, you can't just transfer a loan without a license, right? Selling a loan requires a license to the public. And so because of all these licensing rules, table funding in California becomes very, very unnecessary in a lot of respects. And to the degree that people want to do that, without a license, you run significant risk because the DRE and DBO are very, very active in hunting down unlicensed parties. We defend those kind of cases all the time. And frankly, CFL licenses are relatively straightforward. They're easy to get. DRE licenses are more challenging to get. So a lot of our clients who start out and they don't have the qualifications to get a DRE, they'll just get a CFL.
Okay.
And they can oftentimes use a local broker that they know. Other states out there, they don't require a license to lend on business purpose loans. And so table funding is not really concerned because there's no licensing regime governing the transaction. So.